subject of fundamental of investment. In this lecture, I will be talking about valuation of equity shares, and this is my second lecture on valuation of equity share. In my first lecture, I said broadly financial assets can be categorized in two categories. One is bonds and the other is, that is, we call it fixed income securities, and other is the variable income securities in form of equity share. So in this lecture, I will be talking of valuation of equity share. In my previous lecture, I told you that valuing equity share is more challenging as compared to valuation of bonds, because valuation of bonds, the flow of income which the bonds will provide is easy to predict, right, and it is given, it is predetermined, but what the income stream of income which a share will generate, equity shares will generate, it is unpredictable, it is difficult to predict, right. And while valuing equity shares, we follow basically two techniques broadly. There are two valuation methods. One is called accounting information basis, in which we value the equity share on the basis of either book value of the share or we value the share on the basis of liquidation value, right. So these are the two models of accounting information method. The other model is discounted cash flow techniques. Basically, we value the equity share on the basis of the dividend income, with the dividend income and what will be the price of the equity shares at the end of the life of the equity, when the investor is planning to hold the equity for a particular period of time, right. So in the previous lecture, I took an example that if the investor expect to hold the share for 1 year, right, and the dividend income which he expect or which she expect after a period of time, the price which he or she expect, the investor expects after a period of time, what will be the value of the share, how the valuation of the share will be done, right. In this, now I will be starting with multiple year holding period. That is, instead of holding the share for 1 year, a prudent investor normally when the investor buys the shares, he buys for a fairly long period of time, right. So if your holding period is many years, multiple years, how you will value the share? So in this case, we need to find out the total present value of all expected dividends to be received in future and expected selling price at the end of the holding period, right. So if and the assumption which we are taking is constant dividend model. I am presuming that the dividend that the company will give will remain constant. If the company is giving 10 rupees dividend per year, I am presuming in this model, in this example, I am presuming that the amount of dividend will remain constant. If I am taking that the holding period is 10 years, right, means the investor who is investing in the share will invest for 10 years. And each year the company will give 10 rupees dividend, right. So the dividend is 10 rupees, the period of holding is 10 rupees, 10 years, right. So the investor will be expecting to hold this share for 10 years. So what will be the price of in this case? So the formula which we use, the method by which we value the equity share, if the holding period is more than a year, is P0. P0 is the price in the zero period, that is the current at present, is equal to DT, dividend in the period T. Supposing a shareholder is holding for the 5 years, so dividend in the first year, dividend in the second year, third year, fourth year, fifth year, dividend up to the T period, right. Divide by 1 plus KE. KE is the cost of equity. Cost of equity means when you buying the share, right, what is the minimum return which you are expecting, the required rate of return. When I am saying cost of equity means the required rate of return. What is the return which the investor is expecting to get from that investment? So dt divided by 1 plus ke raised to the power t plus pn divided by 1 plus ke raised to the power n. If I am holding the share for 5 years, so what the price I am expecting at the end of the 5 year? That will be Pn. Cost of equity, I have already said, required rate of return. N in my example is 5 years, if I am presuming that I will be holding the share for 5 years. So the current price, the P0, is equal to dt, dividend in the T periods, divided by 1 plus ke raised to the power T, plus Pn divided by 1 plus ke raised to the power n. So Pn is the P0 is the current market price, Pn is the price at the end of the holding period, right? Ke is the required rate of return, T is the time period, n means n is the period for which I will be selling, I will be keeping the share, right? So if we use this model, and again let me tell you that I am presuming that dividend is fixed year after year. So I am presuming constant, which is also known as constant dividend model. If there is a constant dividend, how you will value the share? This is the point of discussion. So the present value of annuity factor can also be used if dividend are constant. Hence, equation can be rewritten as P0 is equal to D, D means the dividend which we are expecting, multiplied by present value factor annuity at the KE rate for n years, right? Plus Pn multiplied by present value factor at KE rate for nth year, right? So any number of years. So it means if the dividend is fixed, instead of calculating the present value of the dividend year after year separately, what I can do is we can use the annuity method, that is present value factor annuity at the required rate of return for n number of years, right? And what is the present value of the price which the investor is expecting when he will sell the shares. Let me explain you with an example. If an investor wishes to invest in the equity share of ABC Limited for 3 years, means this investor wants to invest in the equity share of ABC for 3 years. The company decides to pay dividend of rupees, means in company pays rupees 3, the investor is investing in ABC and ABC company is giving or expected to give dividend of rupees 3 for all the 3 years, right? Each year it will be giving 3 rupees dividend. And the price at the end of the 3rd year, the investor is expecting will be 80 rupees, right? So there are 3 things. The holding period is 3 years of the investor. The dividend is 3 rupees per year. That is, at the end of each year, the company will be giving 3 rupees dividend. At the end of the 3 year, when the investor will sell the share, the expected price for this investor is 80 rupees. So what will be the current price, or what is the current fair value of the share? This is the calculation. So the required rate of return is 10%. Calculate the intrinsic value of the share. This is the question. If the required rate is 10%, means the investor's expectation is that the investor will invest in that investment which gives her a minimum return of 10%. So D1, D2, D3 is fixed, that is 3 rupees. P3 at the end of the year is 80 rupees. So therefore P0 is equal to 3 multiplied by present value annuity factor at 10% for 3 years plus 80 rupees, that is the Pn, multiplied by present value factor at 10% for the 3rd year. Means after 3 years, when you said what is the present value of this 80 rupees if the required rate of return is 10. So 3 and the present value annuity factor is 2.4868. That is the present value annuity factor if the required rate of return is 10 years and the dividend income is for 3 years, right? So 3 multiplied by 2.4868 plus Pn, right, 80 rupees multiplied by present value factor at 10% of 3rd year, 3, right? So it comes to be 0.7513, that is equivalent to 67 rupees 56 paisa. What it means is that, friends, if the holding period is more than a year, what you do is, and I am presuming constant dividend model, that the amount of dividend is going to be fixed for a period of time for the holding period which the investor is having, right? So in our example, if the required return of this investor is 3 years, is 10%, the holding period is 3 years, the dividend expected is 3 rupees, and the price at the end of the 3 year is 80 rupees. So the price of the share should be 3 multiplied by the present value annuity factor at 10% for 3 years, right, plus 80 into present value factor, that comes to be 67 rupees 56 paisa. So instead of making different calculation, we use the annuity method, that is the dividend multiplied by the present value annuity factor at the required rate of return for n number of years. N number of years are 3 years in our example, and what is the present value of 80 rupees at which the shareholder will sell the share. So in this way you can calculate the current value or the present value, present intrinsic value, present fair value of the share. So that comes to be 67 rupees 56 paise. How will you decide whether to invest in the share or not? Basically, if the available price is less than 67 rupees 56 paisa, the price at which it is available in the market, the investor should invest it. If it is more than 67 rupees 56 paisa, the investor should not invest. Because if the investor is assuming that this is the 80 rupees will be the selling price after 3 years, 3 rupees is the dividend, and the investor's minimum expected return is 10%, right? In that case, the fair value of the share is 67 rupees 56 paisa. So if investor is getting the share for less than this value, the investor should invest. If it is commanding more than this price, as per the constant dividend model, the investor should not invest. This is one case. Now, so dividend model based on growth rates. Practically what happens, the dividend amount does not remain constant. So the case which I have just taken is zero growth or constant dividend model. The other case can be constant growth model and the valuation growth model. Constant growth model means we are presuming that the dividend amount will increase at a constant rate. Say for example, if the company is giving 3 rupees dividend in the current year after the end of the year, the assumption will be at the end of each year, company will increase the dividend by 10%. Means not year after year, every year company will increase the dividend by 10%. We call it constant growth model. The other can be variable growth model. Variable growth model means at what rate the dividend will change. This is not fixed. This is not unlike the constant growth model in which we presume that the growth of dividend will remain constant year after year. But in the variable growth model, the rate at which the dividend will increase, right, is not constant, which is called variable growth model. So zero growth model, right, I have already explained this. Let me take some more example. So we are taking zero growth or constant dividend model. This is the simplest type of dividend pattern in which the dividend amount remains constant over the years. So the value of equity share is determined as follows. I am presuming that the investor will keep the share for a number of years, right? But the dividend amount will remain constant, right? The amount which the company will declare as dividend is constant, is fixed. So in that case, what will be the value of the share? Simply the value of the share will be based on the formula, means in this method, by this method, we can calculate the value of the equity share P0. P0 means the current price of the share, right? And D is the dividend, which will remain fixed year after year. K is the required rate of return, or we call it cost of equity required rate of return, right? So P0 is equal to dividend divided by KE. This is the most simplest method, right? So this model do not make any estimation of future dividends. However, the impractical assumption of the constant dividend itself is the limitation of this method. When the do not make any estimation of future dividend means we are presuming that the dividend will remain fixed. It will not keep on changing. Let us explain with an example. The company having equity share of face value of rupees 100 each pays 15% dividend, right? It means year after year, the company will pay 15 rupees dividend. Each share is of 100 rupee, dividend percentage is 15%, it means the company year after year will give 15 rupees dividend. For an infinite period of time, I am assuming that the company will keep on giving dividend of rupees 15, right? And the investor's required rate of return is 10%. If an investor receives 10% return on his investment, the investor is a satisfied person. Means he feels that, or she feels that, if on his investment, if the investor gets 10%, it is good enough for him. That is, the required rate of return is 10% for him. So what should be the value of the share if dividend is expected to remain constant? So as I said, you can simply use the formula P0, current price, is equal to dividend divided by KE. Dividend in our example is 15 rupees. Required rate of return is 10%. So 15 divided by 0.10, that is 10%, that comes to be 150 rupees. So if an investor invests in a company which is going to give you 15 rupees dividend on a 100 rupee share for an infinite period of time, and the investor's required rate of return is 10%, so the right price, right valuation of the equity share should be 150 rupees as per the dividend model, where the constant dividend remain, means there is the amount of dividend remain fixed, constant, right? So D divided by KE. The other is constant growth model. In this model, it is assumed that dividend will grow at a constant rate, right, year after year. If a firm currently pays a dividend of rupees D, right, then dividend at the end of the year will be, and that is after 1 year will be D1, which is D0, means the current dividend, the dividend in the current period, multiplied by 1 plus G. G is the growth rate, rate of growth at which the dividend will grow. And the dividend of the end of the year will be, and dividend at the end of the second year will be D2, which is called D2 is equal to D0, 1 plus G raised to the power 2, right? Or D2 is equal to D1 multiplied by 1 plus G, and so on and so forth. Means D3, what will be dividend at the end of the third year? That is D2 1 plus G, that is D3, right? So this is called constant growth model. Therefore, dividend payable in any future year will be D1 is equal to D0 multiplied by 1 plus G raised to the power T, right? T is the time period. So there are certain assumptions of the constant growth model, right? So assumption of constant growth models are: the growth rate is constant and compounded annually. They are not compounded semi-annually or quarterly, they are compounded annually. Secondly, the growth rate G is less than the required rate of return of the equity shareholders, right? So means the growth will be less than the required rate. If the required rate of return of the investor is 10%, the rate of dividend that it will be grow, the dividend will grow will be less than 10%, right? So the growth rate G is less than the required rate of return of the shareholders. So how you value the shares on the base of constant growth model, right? We use a formula. The valuation of the equity share can be ascertained with the help of the following equation. P0 means the current price, is equal to D1 means dividend at the end of the first year, divided by KE, the required rate of return, right, minus growth rate, right? So D1 divided by required, KE is equal to required rate of return, G is the growth rate, right? So current price P0 is equal to dividend at the end of the year divided by cost of equity minus growth. How growth rate is determined? So growth rate can be determined with the help of the following methods. You either use the past trend analysis, right? Means using past trend analysis, average growth rate can be obtained based on the past data of dividend. If suppose the company is a 50-year-old company, we can calculate on an average at what rate dividend is increasing over a period of time. So we can calculate the average growth rate, right? So that will give you an idea, fairly good idea, that at what rate dividend is increasing. So you use past trend analysis and calculate that what is the growth rate in the dividend. We call it average growth rate can be obtained based on the past data on dividend. The other can be using retention ratio and return on equity, right? So retention ratio means whatever the income that is being generated by the company, what portion of the profit is being retained. Suppose a company earns 100 rupees dividend, 100 rupees income, or say 100 crore rupees as income, net profit is 100 crore. And over a period of time it has been observed that the company retains 60% of it. So the retention ratio is 60%. That is, company, if it earns 100 crore, it will retain 60 crore as reserve, and rest 40 crore will be distributed or is being distributed as dividend. So retention ratio, which we normally refer as B, right, and return on equity. So the growth rate is determined using the retention ratio and return on equity. So as per the Gordon model, growth rate can be determined G is equal to B. B is nothing but retention ratio multiplied by the return on equity. Whatever the company has made the investment, what return it is getting, right? So the growth can be calculated, growth can be assumed by using the Gordon model, that is B. B is nothing but the retention ratio, and B means retention ratio again means that what percentage of profit is being kept by the company as reserves, as accumulated profits or whatever you call it, right? So that it comes to be B. That is called retained. What proportion of income is being retained by the company, that is denoted as B. So B multiplied by the R. R is nothing but the return on equity, means how much return the company earns on its equity. So that is the growth rate. Now let us explain it with the help of an example. Suppose XYZ Limited is currently paying dividend of rupees 2. That is, company is paying a 2 rupees dividend, which is expected to grow at 5% per annum. Means year after year, this amount of dividend of rupees 2 will grow at the rate of 5% year after year. Find out the value of the equity share if capitalized rate of is 10%. If capitalization rate is 10%, means the required rate of return is 10%, right? So D0 means the current dividend is rupees 2, G is 5%. So what will be the D1 is equal to D0 multiplied by 1 plus G, and D1 is equal to rupees 2, that is the D0 multiplied by 1 plus 0.05, right? So G is nothing but the growth rate, that comes to be 2 rupees 10 paisa. So P0 is equal to D1, that is 2 rupees 10 paisa, divided by KE, required rate of return, which is in our example is capitalization rate is 10%, growth rate is 5%. So KE minus 10% minus 5%, that comes to be 0.05. So 2 rupees 10 paisa, which is the D1 dividend at the end of the year, divided by cost of equity minus growth, right? So that is cost of equity, KE, required rate of return or capitalization rate. Sometimes we use different words for this, right? So KE is 10%, 10 minus 5%, that comes to be 42 rupees. So in the constant dividend model, the constant growth dividend model, we are assuming that the dividend will grow at a fixed rate, and in our example we have presumed that dividend will increase at the rate of 5%, right? And if in the current year, this means at the end of this year, the company has declared, or if I am talking of today, I am presuming that today company has declared 2 rupees dividend, and at the end of the year, first year, means at the end of this year when I am investing, this dividend will grow at 5%, right? And the capitalization rate is 10%, right? So the value of the share will be the 2 rupees 10 paisa, that is D1, divided by capitalization rate minus the growth rate, that comes to be 42 rupees. The current price, the right price of the equity share is 42 rupees. And the other model can be the variable growth model. In this variable growth model is more realistic, because what will be the amount of dividend that does not remain fixed, and even the rate at which the dividend will grow it does not remain fixed, right? So practically it depends on what will be the amount of dividend which the company will be declaring. It depends on various factors. It depends on the dividend policy of the company. It depends on the market situation. It depends on the company's performance. It depends on the life cycle of the company. It depends on the life cycle of the industry. It depends on the macro factors. So that's why we say that dividend also keeps, although the company has its own dividend policy where companies tries to keep the dividend amount, a particular amount, means normally the practice of the company remains, the good companies do practice that it does not at least reduce, if not increase, reduce the amount of dividend. Even in a particular year they don't earn that much profit, because they can use the past profits, accumulated profits of the company for paying dividend to the shareholders. But still the amount of dividend keeps on varying as the company grows, as the rate of growth of the company increases, so is the rate of growth of the dividend also. So this model is more realistic because the dividend may change year over year, that is one growth rate remain same for one or few years, followed by another growth rate for the next few years, right? So means we keep on changing. In the next lecture I will be talking in detail about how you value the share on the basis of variable growth model. So in this lecture what I have discussed, let me recapitulate that I have discussed that if the amount of dividend remain constant over a life cycle of the company, right, how you value the share. If the amount of dividend grows, but if it grows at a constant rate, right, if I am presuming that my dividend amount is 2 rupees today and it will grow at the rate of 5% year after year, which is called constant growth model. We presume that this dividend amount will grow at the end of the 5 years, and if my required rate of return or capitalization rate is X%, they say in our example which I took in this lecture is 10%. So what will be the price of the share, which call it constant growth model. So how you value the share if there is a constant growth of dividend, right? And lastly, we have started talking about variable growth model, right, in which the amount of dividend keeps on varying over a period of time, right? So we'll explain it further in the next lecture on valuation of equity shares. Thank you very much.